1040.com podcast. Your taxes, smart and simple. Hey, and welcome to the 1040.com podcast, episode 8. Today, we are joined by the vice president of 1040.com, James Stork, and this is a big deal, people. It's a big deal. James, how's it going today?
It's going good. It's going good. I'm glad to be here. And honestly, I'm used to being on the other side of the camera, so it's very different being on this side of the camera. But
yeah, absolutely. Normally when we film, James is in another room, and he's watching to make sure that we get our facts straight and our numbers correct, and we just wait for the record button to be hit, saying we're done, and then we'll hear him come down the hall, and the door opens, and it's just like a thumbs up or a thumbs down, and sometimes it's like I could get by if we didn't reshoot it, but you should probably reshoot it.
Mostly it's a thumbs up.
No,
they do a good job.
He's good about it. But there's just stuff we can't get wrong when we talk taxes. It's not like a gray area.
That's right.
It's very black and white.
A lot of numbers.
Yeah. So today is Halloween, right?
Happy Halloween.
Happy Halloween, yeah. We should have like a bowl of candy that we just like crushed the whole time. So you've got kids, 3 kids.
I do.
What are they dressing up as?
So my son, who's my oldest, is going to be a basketball player, and then I have a daughter who wanted to be a witch.
Yeah.
So she's got her witch costume, and then my youngest, it adamantly has been for 3 months has said I'm going to be a policeman, or we tell her policewoman, but she is ready. She saw handcuffs hanging up in one of the Halloween stores one day.
Yeah.
And she said I'm going to be a policeman.
That is
and so
awesome.
She's ready.
Hey, kids, like whatever. I mean.
What about you?
So yeah, we've got a little guy, and he's a Tennessee football player.
Oh man, I'm sorry.
I don't know. I told him. I said, people are gonna tell you that Tennessee's not good this year, and I said, you just need to tell them that we're rebuilding. And so our little 4-year-old, if you tell him like, hey, Tennessee, you should have picked a better uniform. He said, oh, we're rebuilding. And
I'm a Florida Gator fan,
James
so neither one of us has much to talk about.
No, we're both just shamefully sitting on the couch.
Waiting for next year. Waiting for basketball season.
Yeah, I'm definitely not waiting for maybe women's basketball season. So I think I'm going to go as a homeless coach, if you're catching my drift there. And my wife teaches school, so she is going as the mouse from If You Give a Mouse a Cookie, not cheese.
Yeah, I've read that a million times.
Yeah. So we're going to have fun. We're going to have fun. So that's not why we're here, clearly, but we could talk about Halloween for a long time. But instead, we're going to talk about taxes for families today. And again, it's awesome to have you here, just so you know these things inside and out. And being a family guy, it's a great fit. So let's hop right in. When you think about exemptions, you think of it in a lot of different areas, but suddenly when you start having kids, it kind of opens up a whole nother world to tax exemptions, especially for families. So can you touch on that for us?
Yeah, it does. And there's so much for families in the tax code, and until you become a parent, you don't really think about it very much.
Right.
But we could literally sit here for 8 hours and talk about everything that's pro-family in the tax code.
Yeah, buckle up, 8 hours.
Yeah, here we go. No, but there are some key things that apply to a lot of families, and that's what we're going to focus on. There's 2 that we'll talk about right off the bat, and one of them is a personal exemption. You get a personal exemption for yourself and your spouse if you're married filing jointly, but you also get that same amount for each child that you claim on your tax return. And that amount's $4,050. So that's not bad if you got 3 kids, $12,150. And that amount is taken off of your taxable income. So it's what we call a deduction. And it's very helpful, and it's pretty much a gimme. The phase out on the personal exemption is upwards, it's north of $300,000 of adjusted gross income for a married filing joint couple. So most people qualify to take those exemptions and reduce their taxable income by that amount. The other one is a credit. It's called the child tax credit. And it's the first part of this is a non-refundable credit. Now, the child tax credit actually is taken after taxes figured, so it reduces your tax liability. And some of the qualifications, it's a little bit different. The child has to be under the age of 17, And the phase out's a little bit different. It's lower. So if you're married filing joint and you hit $110,000, you start to lose portions of that credit. One of the good things, though, about the child tax credit is that if your tax liability does get reduced to zero and you haven't taken the full amount of that credit, and that credit is up to $1,000 for each qualifying dependent. One of the things the tax code does for us is if that tax liability is reduced to zero and you still haven't taken that full amount, you get to take what's called the additional child tax credit.
Oh, wow.
And that's a refundable credit. So it's a way for at least most of the people that qualify to get that extra amount through a refundable credit.
Right. So touch on working with kids. So there's some incentive, I guess you might want to say.
Yeah, right. So the tax code, like we said, there are a number of provisions that are pro-family, and there's also provisions in there that are pro-work.
Right.
And one of them is the earned income credit. And the earned income credit, you can actually apply for it whether or not you have children. Mm-hmm. But the way it's set up is that it takes, there's this huge table in the tax code. I should have brought it, and we could have put it out. And there's like a millions of numbers. Because what the earned income credit, the calculation does is it takes your earned income amount, your filing status, and the number of dependents you have. And based on those three factors, it tells you the amount of credit that you can get based on what your income limit is. So I brought an example because it's hard to keep all those numbers in your head, but for example, if you were married filing joint and you had 2 qualifying children, you could claim part of this earned income credit as long as your earned income was less than about $51,000. Okay. So everybody gets plugged into that formula. And the earned income credit is refundable, and that's another really positive thing. If your tax liability is zero, you can still get earned income credit back. And again, it's incentive for people to work and and have earned income. That's the key qualifier for that credit.
So when as parents start working, one huge thing that comes up is always childcare. And I think no matter where you live in the U.S., childcare is not cheap. Some people have grandparents and parents that can help out, but I think for most people we're looking at some type of babysitter, some type of daycare, preschool, that type of thing. So talk about, there's some opportunity there within childcare that a lot of people might not know about.
That's right. Man, kids are expensive.
They really are. They really are.
If you don't have kids yet, understand. Kids are expensive and
worth it, but expensive.
Absolutely worth it. But you're going to spend some money. And like Paul was pointing out, if you have, if you and your spouse are married and you're both working, then you've got to find somewhere for little Timmy to stay. Right. And unless you're lucky enough to have grandparents, maybe locally. But a lot of us end up having to find that daycare, and you have to spend money for that. And that's, Paul was saying, preschools, daycare programs, even summer camps can count for this. And your children in this case have to be ages 12 or younger. And this is important. You and your spouse either have to be working, or one of you or both of you have to be looking for work if you're unemployed, and you have to be able to prove that you're looking for work. Or one of you or both of you have to be full-time students. So there's some definite qualifiers there to make sure that this is rewarding or going to those, helping those working parents that have these additional expenses. Right. The credit is a little complicated, but you get the credit. The credit is calculated by taking up to 35% of qualifying expenses of $3,000 for one child, or up to $6,000 for two or more children. Okay. And then the more you make, that percentage starts to decrease or decline.
But there is opportunity there that is absolutely worth looking into.
Yes, you definitely want to take advantage of that credit. A couple of other important points about it: if your employer is paying any amount of your dependent care expenses for you, and some employers will do that, you have to reduce the qualifying expenses that you paid by that amount. Also, the child independent care credit is non-refundable.
Okay. Yeah. So talk about working, if you're a single parent working, and what that kind of looks like from that standpoint.
Right. So if you are single or unmarried and you're taking care of your children, you can take advantage of what's called the head of household filing status. And there's some specific benefits to taking or claiming that filing status rather than claiming single. So if you are single or unmarried, if you are paying more than half the cost to maintain your home, and for example, those are expenses like a mortgage or rent or property taxes or property insurance, groceries. If you're paying more than half of those expenses and you have one or more children that are living with you for more than half the year, then you can claim head of household filing status.
Right.
And what that does is it gives you the standard deduction for head of household is $3,000 more than single, and you get taxed at a lower rate. So it's definitely important to take advantage of that if you fit the criteria.
Awesome. So we've kind of touched on the younger side of children, with daycare and opportunity there, and head of household. We've covered some really good things, but there's one last thing we want to talk about, where there's an opportunity to save and not be taxed with the 529 plans. Could you touch on that for college savings and what that looks like?
Yeah. So have you started even thinking about
we
saving
have
for college?
Yeah,
have you?
we
Good.
have. So it's scary, but we have.
It is.
It's not cheap. I mean, and again, we say kids are expensive, but when you start getting to the college thought, it's like, whoa, all right.
Yeah, it is.
It's worth starting now.
Nobody can plan on their kids getting full rides to college.
Right.
That would be great, but
Yeah.
that's not something that you can count on. So what they have is this, it's a savings vehicle called a 529 plan. And my kids are to the point where they're getting up there in age, and I'm starting to do the math on, okay, they're going to be in school in this many years. So I have invested in 529 plans. And the nice thing about them is, probably the most important thing about them is that it's intentional. You can have savings and say, well, I'm going to use some of this for education expenses down the way. But when you intentionally say, I'm putting money in this account for this child, and that money is going to sit in there, and everything it earns, everything that plan earns is tax-free.
Right.
And then when you take distributions out for qualifying education expenses when they start going to school, it's not taxed. So it's a nice vehicle for savings and for getting some tax breaks and being intentional about putting money aside. And sometimes you may not put as much aside. You may, if you do it quarterly, which is what I do, you may put more in one quarter than you do in another.
Right.
But you're at least thinking about it, and you're putting that money in there, and it's a great way to get a head start on saving for those college expenses that are coming.
I like that you're saying it's intentional. You can always put money in savings accounts, but life happens, and it could be something medical related, or you end up needing to buy a car in an emergency, or and so having this money that is set aside specifically for that, I think is huge, especially for young parents planning long term. That it's sitting there, and you can't really get in the way of it. That's what it has to be used for.
Absolutely.
To be able to pull out from that. So I'm going to kind of throw you on the spot here. There's a lot of information that we've covered, and it would be easy to just like gloss over and kind of check out. But could you touch on how the 1040 platform works so that people understand, our listeners, our viewers understand that they don't absolutely have to know the ins and outs of all these plans. So how our question form or system works when you use 1040.com to file.
Yeah, that's actually a really good point, because we sit here and we talk about this, and I'm sure it's overwhelming for some people to hear these numbers and think, well, how am I going to calculate, get the calculator out and figure out all these expenses. The great thing, when you're going through 1040.com, we try to keep it very simple and ask you the questions that we need to ask in order to do all these calculations, so that you don't have to do them. We need to know if you're married, how many kids you have, when were they born, and we take you through all of these questions that you know the answers to. And then we can do all of these tests behind the scenes to determine, one, if you qualify, and then two, how much you qualify for. And all of that math is taken care of by our tax wizards that are writing code behind the scenes. And we provide you with a very user-friendly experience to where you don't have to get overwhelmed by that.
Perfect. That's exactly. It's just so easy to go, I'm done. I'm not doing this. But just know that when you use 1040.com, we do our best to make it extremely easy for you and make it a simple process. So thank you for being here. I got one last question for you. Favorite candy? Halloween is today. Halloween candy.
Favorite candy.
Like your kids are going to get home tonight.
What am I going to
Yeah, what are you stealing?
steal?
And you get 3 pieces. So 1, 2.
I usually end up with the Almond Joys.
Okay.
They don't like the coconut or something in them, and I'm coconut almonds, chocolate.
So
that's
you
right
like
down
it
my
and they
alley.
don't like it. It's
Yeah.
perfect.
So
All right.
I usually, that's what I go
Fair
after.
enough.
Yeah.
Fair enough. All right. So, James Stork, thanks for being here today. And hey, thank you all for watching, for listening. Don't forget to share with your friends. Comment. Let us know what you're thinking. Let us know if you have any questions. And keep tuning in. Thanks.